Hey everyone, and welcome back to the channel where we demystify the complex world of hard-to-borrow stocks and potential short squeezes. Today, we're diving deep into a fascinating situation that's lit up our screener, NCRA Inc., trading under the ticker NCRA. This stock is showing some truly eye-popping cost-to-borrow fees, and we're going to break down exactly what that means and why it could be significant. But first, a critical word. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Let's talk about NCRA, NCRA Inc. This company operates in the consumer defensive/packaged food sector, specifically focusing on acquisition-driven growth within land-based recirculating aquaculture systems. They are involved in fish farming, selling aquatic products, and producing food products. Currently, NCRA is a microcap with a market capitalization of just $2.03 million. Looking at its recent price action, it's been a tough ride. Today, NCRA is down 7.55%. Over the last 5 days, it's shed 26.50%, and in the past 30 days, the stock has plummeted a significant 77.93%. Volume has also been notably low recently, with today's volume at 117,400 shares, which is only about 0.1 times its 30-day average volume of 1,271,655 shares. What is cost to borrow and why it matters? So, what exactly is cost to borrow? In simple terms, it's the annualized fee that short sellers have to pay to borrow shares of a stock before they can sell them. Think of it like paying rent for shares you don't own. When this fee skyrockets, it's a strong indicator of either extremely high demand from short sellers to bet against the company, or, more often, a severely limited supply of shares available to borrow. When the cost to borrow, or CTB, exceeds 100% annually, it's telling you that short sellers are paying a premium just to maintain their positions. It's a key metric for identifying potential short squeeze candidates because it reflects the pressure short sellers are under. Why the stock is hard to borrow right now. Now let's get specific with NCRA. This stock didn't just appear on our hard-to-borrow screener by accident. Show chart highlighting CTB. The current annualized cost-to-borrow fee for NCRA is an astonishing 1093.1%. That's not a typo over 1000%. What's even more striking is the momentum behind this fee. It has surged by over 10-15 percentage points in just the last 5 trading days. This kind of explosive increase signals immense pressure. Furthermore, the number of shares currently available to borrow is incredibly low, standing at just 1,000 shares. To put that in perspective, NCRA has an estimated float of only 0.5 million shares. Our internal composite squeeze score, which factors in CTB level, momentum, borrow supply, float size, and price action, rates NCRA at a high 86.1 out of 100. This confluence of factors points to extreme scarcity and high demand to short, pushing borrow fees through the roof. Squeeze mechanics explained. For those new to the concept, a short squeeze occurs when the price of a stock rapidly increases, forcing short sellers, who had bet on the price falling, to buy back shares to limit their losses. This buying action further pushes the price up, creating a feedback loop as more short sellers are forced to cover. When a stock like NCRA has a tiny float of 0.5 million shares and only 1,000 shares available to borrow, even a small surge in buying pressure can trigger this mechanism. Short sellers paying over 1,000% to stay short are effectively paying a ticking time bomb. However, it's crucial to understand that a high cost to borrow does not guarantee a squeeze. It can also signify that short sellers have incredibly strong conviction that the stock will eventually decline, and they are willing to pay almost any price to maintain their short positions. Dilution risk check. One of the biggest threats to a short squeeze thesis is dilution. Dilution happens when a company issues new shares, increasing the total number of shares outstanding. This influx of new shares can provide short sellers with an easy way to cover their positions, or simply depress the stock price due to increased supply, effectively negating any squeeze potential. We've thoroughly checked for NCRA. No recent dilutive SEC filings like SMINUS-1, SMINUS-3, or 424B have been found in the last 90 days. This is a positive sign for the squeeze potential, as it indicates the company hasn't recently flooded the market with new shares that could absorb short covering or depress prices. Recent reverse split watch. Another important factor for NCRA is its recent corporate action. NCRA Inc. executed a 1-for-30 reverse stock split just 6 days ago, on July 7th. A reverse split reduces the total number of shares outstanding and proportionally increases the share price. For example, if you own 30 shares at $1 each, after a 1-for-30 split, you own one share worth $30. While reverse splits are often done by struggling companies, historically, many microcap stocks tend to see renewed volatility or even a price pop within about a month after such an event, as the reduced float can make the remaining shares even scarcer. This is a pattern observed in some microcaps, not a guarantee, but it certainly adds another layer of intrigue to NCRA's current setup. Again, a reminder. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. So, what should you be watching for with NCRA? First, keep an eye on that cost to borrow fee and its momentum. If it continues to climb or stays incredibly high, the pressure on short sellers remains. Second, monitor the available shares to borrow. With only 1,000 currently, any increase in demand to short could dramatically affect this. Third, watch for any signs of buying interest and increased volume. A stock that's done over 77% in 30 days like NCRA could be oversold, and any positive catalyst or shift in sentiment could trigger a reversal. Finally, consider the context of the recent reverse split and the historical tendency for some microcaps to experience increased volatility in the weeks following. NCRA Inc. NCRA presents a truly unique situation with its staggering 93.1% cost to borrow, rapidly shrinking borrowable shares, and recent reverse split. It's a textbook example of a hard-to-borrow stock with significant underlying pressure. While there are no guarantees in the market, understanding these mechanics is crucial for identifying potential high volatility scenarios. Remember, knowledge is your most powerful tool. If you found this breakdown helpful, please smash that like button, subscribe for more deep dives into hard-to-borrow stocks, and let us know in the comments what stocks you're watching. We love hearing from you.